Hey all, welcome to ShareTreck, where science meets investment. And I'm your host, Raj. Over the past few weeks, friends, I have shared my concerns with you. Concerns about the rising uncertainty in the markets, from the chaos of shifting tariff policies to back to school and holiday inventory risks. Now, JP Morgan CEO Jamie Dimon is ringing the same alarm bells. In this video, we'll break it down what Jamie Dimon is warning about and why he believes the market surprise is looming, why retail investors may be misreading the mood of the market, how the bond market, inflation, and deficits are combining into a potentially unstable cocktail, and why complacency in the face of global risk is dangerous and what you can do about it. Let's get into it. In a recent interview with Fox Business, Jamie Dimon said flatly, complacent. Prices are high. I think the odds of a soft landing are lower than other people think. What is he talking about? Well, Dimon sees a market that's been lulled into a false sense of security, inflation has moderated, GDP is holding steady, and unemployment hasn't spiked. But under the hood, there are vulnerabilities building, runaway deficits, geopolitical shocks, unstable trade alliances, and rising interest costs. All of these are at the core of it. At the Reagan National Economic Forum, Dimon put it more bluntly. The US massively overdid COVID spending and quantitative easing. A crack in the bond market is going to happen. He's not saying we are guaranteed a crash tomorrow. He's saying the market is mispricing risk and that it's a dangerous situation. Let's face it. Most investors are looking at S&P 500 and saying, hey, everything looks fine. But the problem with slow-moving structural risks is that they don't show up until it is too late. We have seen this before, dot-com bubble, the 2008 housing collapse, the March 2020 pandemic shock, all have periods of calm before the sudden storm. Right now, the tariff regime is adding dry powder to the stock. The Trump administration's big beautiful bill currently in the Senate includes sweeping new tariffs. At the same time, deficit hawks are claiming it will fix the budget. The Committee for a Responsible Federal Budget disagrees, estimating it could add $2.5 trillion to the deficit over the next decade. If the courts uphold the latest legal challenge to the Presidential Tariff Authority, it could further weaken investor confidence. Treasury Secretary Scott Bessent brushed off Dimon's warning, saying, Jamie's made prediction like this his whole career, and none have come true. And he's right to some extent. But you have to think about this. Jamie Dimon always tries to look around the corner. As a risk manager, that is his job. We also have the big shot guy, Steve Eisman, who is echoing the concern. He told CNBC, I have one concern, and that is tariffs. He flagged the trade negotiation with Europe and China as too many balls in the air being juggled at once. So let's take stock. Dimon is concerned about the complacency and the bond market fragility. Eisman is watching tariffs as a serious destabilizer. And I have been saying more or less the same thing in this channel for weeks, but in different words. The uncertainty from trade policy, geopolitical flare-ups, and deferred crises hasn't gone away. And even if we get a minor reprieve here or there with the tariff, the underlying issues still remain. And in this juncture, the question you and I are asking ourselves is, so what can we do about it? Let's look at all the logical steps. First, reassess your exposure. If you have been chasing the rally, thinking the storm has passed, it might be time to rebalance. Defensive positioning, gold perhaps, real estate, cash equivalents. Those may probably help protect your downside. Secondly, look at companies with a really strong balance sheet and predictable cash flow. This isn't the time to be speculative on unprofitable moonshots, and that probably is one of the reasons why I'm not getting into CRISPR right now, even though I believe in that company 100%. I believe in the CEO, and I believe in their therapies and the technology and their expertise. It's a world-class company, and it's pretty cheap. But I don't want to get into this right now because exactly because of the overall environment. The third aspect I would say is that we should monitor macro signals like bond yields, CPI trends, and global PMI data. Even small shocks could now have amplified effects in an environment that is this stretched. It has been stretched out like an elastic, and when it snaps back, it will be volatile. Finally, stay mentally prepared. That doesn't mean panic. It means don't be caught off guard. It's if volatility spikes, because as Dimon said, when something goes wrong, you usually get surprised. So be prepared for the surprise and you'll do just fine. Well, friends, if this video resonates with your view of the markets, hit the like button to let the algorithm know. And subscribe to ShareTreck so you're never left behind in the fog of macro risk. So my question to you now is, having listened to everything I had to say, what do you think? Is Jamie Dimon sounding the right alarm, or is this another false flag? Drop your thoughts in the comments below. I always look forward to hearing from you. That brings me to an end of this video, my friends. Bye for now, and I'll catch up with you again in the next video.